Hello and welcome back to our third video lecture. In this video we're going to look at make or buy analysis decisions. Now before we get into this, we're basically doing the same exact thing we did in the prior video, as well as implementing what we learned in video 1. Differential analysis. We have to be able to identify relevant and irrelevant cost and benefits. So we have to be able to pick out differential revenue, differential costs, incremental costs, avoidable costs, and basically just being able to recognize that any revenue or cost that differs between two situations or two scenarios are relevant, and we need to assign a monetary value to those differences and see if we should continue to make something or continue to buy something. Now, this make or buy decision is kind of interesting because it requires a certain type of company. Okay, try to give you an example. Best example I can give you would be laptops, computers, right? There's Dell, HP, Apple, I just drew a blank, but fill in the blank for any computer brands you can think of. Now, all these computers use processors, right? Where do they get their processors from? Well, Intel, right? Intel makes processors and chips and whatnot that go into computers, okay? So the idea of a make or buy decision, the company has to, or what the company does is they perform more than one activity within their value chain. Okay, so let's just take HP for example. HP uses Intel Core processors. Let's say that HP got a great idea to make their own processors. So they have a decision. We have some space in the factory, we have some talent within the organization, and we're at a point where, or HP's at a point where they could either make their own processors or they could buy them. Okay, meaning we take that process of purchasing a supply from a supplier and we turn it internally. We produce it ourselves and we put it into the computers that we also make. Okay, so that's what we're talking about here. We're talking about a make or buy decision. Instead of buying a supply from somebody else or a component part from somebody else, we're going to do it internally. Okay, that's all we're looking at. So what are the advantages of this vertical integration? Well, think about it. Instead of buying a supply from somebody or a component part from somebody else and we make it internally, well, we're able as the company to maintain control, specifically quality control. We can make sure that we have enough processors or component parts or raw materials, whatever we need to make that computer. If we make some of those components in-house, we have a better flow of parts and materials to make that computer. Okay, now if we can do this cheaper than somebody else, meaning if HP could make processors for their own computers cheaper than what they buy their processors for from Intel, then they're going to realize a profit. Okay, so vertical integration does have its advantages. However, it also has some disadvantages, right? We need something called economies of scale, right? Basically what we can do, or basically what economies of scale says is, or what the advantage is is that we may not be able to take advantage of suppliers, right, who can create economies of scale, meaning somebody who makes processors like Intel can do it better, faster, and cheaper because they make a ton of processors for a number and they supply to a number of tech companies. Okay, so what happens is Intel is able to pull all the demand from different companies. Well, if we're making processors for ourselves, we lose that economies of scale. Okay. However, we have to recognize that economies of scale, although we can get the product cheaper, we have to be careful because we want to make sure that we retain control of the activities, right? The activities that are important for maintaining the competitive advantage. So let's take a look at a buy or make or buy example here. Okay, so there's this company, Essex Company. They manufacture part 4A. That's the name of the part, 4A, and they use this part in a product. Okay, so we have in front of us here the unit product costs for part 4A. We have $9 of direct material, $5 direct labor, variable overhead of $1, special equipment depreciation of $3. We got the supervisor salary, and we have general overhead. So it costs us $30 to make part 4A. Okay, we're thinking it costs us $30 to make it. Can we buy it from somebody else cheaper than it costs us to make it? I don't know. Let's see. So we get some more information. Excuse me. The special equipment that we use to make this 4A product has no resale value. Okay. The reason why that's important to us is because if it had resale value, that would be a benefit we would have to consider. Okay. Since the fact that it has no resale value, we have no benefit to consider regarding that special equipment. Okay. They go on to tell us that the total amount of general factory overhead, which is allocated based on direct labor hours, would be unaffected by the decision. So our general factory overhead is going to be the same regardless if we continue to make or we decide to buy from someplace else or from a supplier. In that situation, general factory overhead is irrelevant because it doesn't differ between me making or us making the product or us buying it from a supplier. Okay, they go on to tell us that the $30 unit product cost is based on 20,000 parts that are produced each year. An outside supplier comes to us and says, hey, we can provide you with the 20,000 parts that you need, and it's only going to cost you $25 a part. So we have a decision to make. Should we stop making this part 4A and buy it from the outside supplier? Well, in order to do this, we need to do a make or buy decision. So we're going to do some differential analysis. We're going to calculate the cost to make it versus the cost to outsource it or buy it. Okay, so here's what we have right here. We have the price of, well, first of all, we're looking at the cost for 20,000 units because that's what we need. Okay, we have our internal costs, which add up to $30 per unit. Okay, this other person says, or the supplier says, we'll sell to you for $25 a piece. Right off the bat, 25 is cheaper than the $30 that it costs us. Okay, so right off the bat, hey, yeah, we should take that deal. just solely based on the cost per unit. But when we dig a little deeper and we do our differential analysis, we say, okay, if I'm going to buy 25,000 or 20,000 parts at 25 bucks a pop, that's going to cost me $500,000 to buy it. Okay? Let me compare that to the cost that I incur to make it. Okay? Well, to make these parts, direct material is $9 per unit, so that's a cost me $180,000 in direct material to make these units. Direct labor cost me $100,000 in direct labor to make these 20,000 units that I need. Variable overhead, $20,000. It costs me, or I incur, to make these products. Depreciation of equipment. This is a sunk cost. We don't include it. It's a sunk cost. It already happened. It's an irrelevant cost. Okay. Supervisor salary. Well, if we continue to make, we still got to incur this $2 per unit, which is 40,000, and the allocation of general factory overhead. We said that that's an irrelevant cost, right? We still incur it regardless if we make or if we buy, so we do not include that in our analysis, right? Because this isn't a differential cost right here. It still remains the same. So we can see, just looking over here, that it's actually cheaper for us to make it than to buy it. To make it, it would cost us $340,000 to continue making. To buy it, it would cost us $500,000. So the avoidable costs that are associated with Part 4A, those are the direct materials, the direct labor, the variable overhead, and the supplier salary. Those are the costs that differ based on the decision I make. If I decide to buy, I avoid those costs. Okay? So again, we see here that the sunk cost of depreciation, that was the cost we incurred to buy that equipment. It's sunk. We don't consider it, right? Oh, sorry. The general factory overhead. They said that this represents an allocated cost, right? Meaning we allocate general factory overhead to this component part. Okay, it's common to all items that produce in the factory, so it's unchanged. Because it's unchanged, it's irrelevant. So we can see here that the difference between the 500,000 and 340,000 is 160,000. There's a financial advantage for us to continue to make Part 4A. Okay. Real quick, we already defined opportunity cost, right? We know it's what you give up to get something, right? That's how we defined it. What you give up to get something. The benefit that is forgone as a result of pursuing some other course of action, okay? It's important to recognize that opportunity costs really aren't actual cash outlays, right? So opportunity costs are never ever recorded within the financial accounting. Okay, very important that we recognize that opportunity costs, yes, we consider it if it exists in a decision, but it never hits our books. Okay, so let's say, for example, that the space that this company uses to make Part 4A had an alternative use, right? They could rent it out. They can use that space for some other means. Okay. If it had an alternative use, we would actually have to include the opportunity cost, okay, in that scenario. The next decision we have to make is whether should we accept or reject the special order. Guess what? We're doing the same exact thing. Identifying the differential costs and revenues, um, placing a value to those differences, comparing them, and then making a decision. So we'll hit that when we come back in our next video.